There is a specific chart formation called the Ascending and Inverted Scallop. In a bull market, it boasts an average post-breakout rise of 43%. Today, we are going to break down how to identify this exact shape on your charts. We will cover how to filter out the false signals and how to execute a mathematically sound trade when the conditions align. Before we start, make sure you are looking at a daily chart. You also need a working understanding of basic support and resistance levels. By relying on a strict, mechanical checklist for this pattern, you remove the guesswork. You trade based on verifiable data, giving you a quantifiable edge over traders relying purely on intuition. This chart shows the required starting environment, a clear, established upward price trend. You can see the price climbing steadily from the bottom left toward the upper right. Within that uptrend, look for a shape that resembles a backward, upside-down letter J, or the right half of an open umbrella. The pattern starts at a minor low, rises to a rounded peak, and then declines into a new valley. The depth of that final decline is important. On average, the price drops about 50% from the peak. The absolute rule here is that this right valley must remain higher than the initial starting point of the pattern. If it drops below that start line, the pattern is invalid. Looking at a new example on this chart, notice the top of the formation. It forms a smoothly rounded curve. You want to avoid patterns that flatline at the top or form sharp, jagged spikes. Sometimes the daily high prices look chaotic, like a single tree sticking out of a hill. If the highs are messy, examine the daily lows. If connecting the bottom of the candles forms that smooth, rounded dome, the pattern still qualifies. Sticking rigidly to these visual requirements protects your capital. It prevents you from seeing a pattern where there is only random market noise. Finding the correct shape is only the first step. The most common mistake traders make is buying immediately after the right valley forms. Without confirmation, the price can easily continue dropping. To confirm the trade, draw a horizontal line at the highest peak of the scallop. You must wait for the price to break through that line and, crucially, record a daily close above it. Until that closing bell rings with the price above the peak, you do not have a valid ascending and inverted scallop. No daily close means no trade. Professional trading requires a defensive mindset. You should actively look for structural flaws to disqualify a setup. On this chart, we see 3 potential setups. The first one fails because the top is flat, resembling a rectangle. The middle one fails because its peak forms a pointed, symmetrical triangle rather than a smooth dome. The third pattern on the right is the most dangerous trap. The price drops below the initial starting low of the formation before it ever reaches the confirmation line. This is a failed pattern and a trap for early buyers. You must also evaluate the surrounding environment. This chart displays a scallop forming during a broader downward trend, directly underneath a heavy ceiling of historical price resistance. The overhead pressure suffocates the breakout, dooming the trade from the start. Occasionally, a valid pattern will confirm, rise less than 5%, and then sharply reverse. This is called a busted pattern. Once the price breaks below that right valley, it often triggers a severe decline, presenting an opportunity for a short selling setup. Passing on toxic setups, like patterns under resistance or in downtrends, preserves your account balance and ensures your long-term win rate remains mathematically profitable. Once you have a confirmed valid setup in a healthy environment, you need an immediate execution plan. That means calculating exactly where you will take profits and where you will cut your losses. Looking at this chart, we use the measure rule to find our target. Take the highest price at the peak and subtract the lowest price at the start of the pattern. That gives you the formation height. Add that height to the peak price, and you have your projected target for taking profits. For your protection, place your initial stop loss slightly below the floor of the right valley. If the price falls through this level, the setup has failed and you exit immediately. As the trade moves in your favor, you can protect your gains by trailing your stop loss. Draw an upward trend line connecting the starting low to the right valley. Extend this line forward and move your stop loss up along it as the price climbs. Using these calculated targets and strict stop loss levels completely removes human emotion, fear, and greed from your exit strategy. Let's review the complete process. You locate the J shape in an uptrend, demand a daily closing confirmation, and apply the measure rule to define your risk and reward. Your ultimate statistical advantage comes down to market timing. Only trade the ascending and inverted scallop in a confirmed bull market. Under those conditions, this pattern has an exceptionally low 4% break-even failure rate. Remember, trading stocks involves risk, and past performance is no guarantee of future results. Always conduct your own due diligence. You now have a precise professional grade setup. Use these rules, respect the confirmation, and trade the data.